Welcome to Allgen's market update. Today is April 10th, 2019. Happy tax season. So I wanted to go over today a market update, just kind of giving you where the market's at, what's going on in the market, and what we're doing about it. So let's hop right in. So the chart we're looking at right here is the S&P 500. It has started off with quite a bounce to begin the year. Coming from the December 24th low of last year, the market is up, the S&P 500 is up about 15%, and it's now actually approaching its prior highs, its all-time highs of September / October of last year. So we're getting to a very important test right here, and if it can make it above that, that would be a positive. However, if it's not able to make it above it, then it could potentially go lower. So one thing that has got us concerned that we have been talking about for quite some time now that has officially given the signal is an inverted yield curve. What is an inverted yield curve? So an inverted yield curve, so basically a yield curve in general is a measure of all the different yields from short-term yields to long-term yields of U.S. government bonds. And so typically in a strong economy, you have your long-term bonds, like your 10-year or 30-year Treasury bond, yielding a much higher yield than your short-term bond. That would indicate a strong economy. However, when times start to get a little shaky or the economy starts to potentially slow down, short-term yields will go up higher than long-term yields. And there's a lot of reasons for this, and I'm not going to get so much into that today. However, what I do want to cover is the most important thing. Since 1968, the last 7 recessions were preceded by the yield curve going negative or going inverted. And so what an inverted yield curve means that the short-term yields are now higher than the long-term yields. And so you're just looking at this chart. This is the actual 10-year and minus the 3-month Treasury contract. And when this goes below this line, that's when it goes negative or inverted. And so that's the signal that it gives when the market is potentially go into a recession, or when the economy is going into recession. So I'm just looking at the last 2 recessions, which are these gray areas right here from 2001, 2002, and then obviously the financial crisis in 2008 through 2009. So you can see how the yield curve went negative actually prior to each one of these recessions. And just recently, in fact, March 22nd, we went negative again after 10 years. So the great thing about this indicator is that it gives you, it leads the actual event, which means it gives you the signal with a good amount of time to make preparations. In fact, it typically gives you a signal about a year prior to a recession. In fact, it's actually 11 months prior to a recession. But a lot of times the stock market leads the recession. So the stock market will typically go down prior to the recession actually happening. So what all that means for us and what we've been preparing for the last 6 months is the market to potentially go through a rough time, a difficult time, a potential market decline. And so we have been going defensive. In fact, going back to this chart, this recent market rally with the S&P 500 going up, the large caps, small caps, international, pretty much across the board, stocks have been going up. We've been using this strength, and we plan on continuing to use this strength in stocks to sell some more stocks and to increase our bonds. And that is all in preparation for a market drop. I could be wrong. See, there's no perfect indicator out there, but I would rather be wrong, or we would rather be wrong and potentially miss out a little bit on the upside than be wrong and lose a lot on the downside. So we're making defensive preparations right now for what could be a difficult time in the market. The good thing is that this signal, the inverted yield curve, gives a signal early, so we're trying to make the preparations before the market actually takes any significant drop. However, if you look back here in 1998 when it first went inverted, the stock market continued to go up for a couple years after that. In fact, and when they first gave you this, in 2006, when it gave you this signal, the market went up a little bit after that. So there is still the potential for the market to go up. However, we want to be prepared for when it drops, because we've been in a long bull market, 10 plus years, and an economic expansion that's 10 plus years. That's typically very long before any type of bear market, and so we believe it's coming sooner rather than later. Now, that's kind of the bad news. The good news is that right now the Federal Reserve started the year saying that they were going to raise rates 2 times, right? And but they've in about early January they shifted that to say we're not going to raise rates at all. We're going to keep them flat. And now actually, if you study what's called the Fed funds future rate, which is a predictor of future of Fed funds, excuse me, it's a predictor of Fed rates in the future. And so if the chart we're looking at right now is showing you in January of 2020 where the futures are predicting interest rates to lie. And so we're right now between 2.25% and 2.5% on the short-term federal funds rate. And so right now it's predicting a 40% chance that we won't change, that will stay right there, but a 60% chance that the Fed will ease rates, meaning the lower rates. And so typically when interest rates are going up, like we've experienced over the last few years, that's bad for bonds. Bonds typically don't do well during that time. However, in an environment where rates are going down, bonds typically do well. And so that's another reason why we've been shifting towards bonds, because bonds typically do well in a declining interest rate environment, and we believe we're going into that environment. So to sum it all up, we believe it's nice that the market's had a nice strong rally to start the year. We've been using some of that strength to take some profits and sell some stocks as they've been going up, and we continue to try to get a little bit more defensive. We've already started getting defensive in October of last year. We continue to do that now, and in preparation for what we think is a difficult time in the market. That being said, we think it's also a potentially positive time for bonds. So we've been increasing bonds, and just to kind of stay true to the nature and the philosophy of how we invest, we try to manage risk, protect our clients' accounts on the downside, but over a full market cycle, do a very solid job net of all of our management fees. And so right now we believe it's time to play defense, but we're getting our portfolios ready for whenever the next time the market drops, we're ready to go on the offense again. So hope this helps, and hope to talk to you soon.